We're going to crack straight on with our opening panel, the Investment Leaders panel, and I'm delighted to welcome a list of experts to set the scene for the conference this morning. First of all, in no particular order, or actually alphabetical order, from Baker Steel, we have Mark Burridge, who's a managing partner there. We have from JP Morgan Global Natural Resources Fund, their portfolio manager, Neil Gregson. Rob Crayford, who's a portfolio manager with New City Investment Managers, and Stephanie Clement de Givry, who's the global head of metals and mining finance at Societe Generale CIB. So if our panelists could join us on the stage, please. So just grab a microphone there. And during the course of this panel, we very much encourage questions from the audience or comments from the audience. So if you hear something that you'd like further clarification on, please do stick your hand up. We'll have a mic, we'll come to you. Please ask a question. If you have a comment that you'd like to make, all experts in this room, so please do feel free to pitch in. Okay, well, let's start at this end with Mark. And we want to sort of set the scene for the conference. So sort of tell us a little bit about how you feel 2018 has gone so far.
Yes, thanks to One to One for organising this. Much appreciated. No, I think 2018, I predominantly focused on the precious metals sector, so I'll talk a little bit from that perspective, and we can get some different perspectives from others. So it's been a bit of a mixed start to the year. I mean, gold has, did try to rally a little bit, but the equities stuck, were stuck firmly underperforming the gold price, and we were kind of hoping that was going to be a trend that would be broken. But what seems to be, so we're a little bit nervous that investors haven't really embraced the mining sector as a whole, or gold, after the last, arguably 5-10 years of capital destruction. So we think that 2018 is going to be quite a change year for the sector. We have potentially the return of inflation, which might be good for commodity prices or precious metal prices, but is also going to add cost pressures to the companies. We've got investor base that's skeptical about companies' capital discipline and management, so we need to go through that. But looking beyond that, I think we're quite optimistic, because we do see that many of the companies in the sector are showing much better management and capital discipline. We see a lot of macroeconomic factors looking for a good drive for commodity prices, including precious metals. And we see a sector that's hugely undervalued compared to the broader market. And if you look at the fundamentals of some of these companies and ignore what the product is that they're manufacturing, they've got great balance sheets, great margins, and good growth. So we think as long as the sector sticks to a disciplined and business-like approach to business, then they will be rewarded with higher share prices and more investors.
Given a relatively solid gold price and good cost discipline by the miners, why do you think gold mining equities have underperformed?
Would you like me to get that one? I think it comes to investor trust in management. I think last year it was probably an effect of stock market setting all-time highs and the rise of cryptocurrencies attracting investor attention. But I think the situation we find now is that we see this a lot, because we go out to investors in our fund, and the question we get asked every other meeting: has the sector really changed its approach? Are they still going to spend capital on value-destructive M&As? Are they still going to spend large amounts of capital on low-returning or negative-returning projects? And we get asked that question all the time. We think that actually the sector, on average, but not all companies, has moved on from those bad old days, I think there's a real opportunity for those companies that are focused on organic value creation and sustainable growth to really start to emerge in investors' views. But right now, there's a healthy degree of skepticism amongst specialist investors like us, and definitely amongst generalist investors for the sector. Mm.
Just add to that, though, a lot of it was self-inflicted. I mean, we had, even by the standards of the gold sector, a lot of disasters. Eldorado, Torex, Tahoe, level of blame onshore, but Acacia. So, for people investing in gold shares, they were pretty tough times for what seemed, a couple of years ago, reasonably well-run mid-cap gold companies. So I think it's some of the mistakes of the past are still being repeated.
But there's a lot of mining companies out there, and there are some which are well run, some which are not so well run. Should everyone be tarred with the same brush?
I think there's a reason they are tarred with the same brush. Even the well-run ones have generally executed poor M&A, kind of buying at the top of the cycle, so have destroyed capital, and that's been something that's really concerned investors. But I think 2018 is a bit of an inflection year, I think. We've had, we came from 15, everyone thought companies were going to go bust. 2016, we had a relief rally. 2017 was more of a consolidation, and then we're going into 2018, and it's a bit of a show-me market. People want to see whether these companies can actually deliver. Do they keep returning capital? And we've seen larger companies generally focusing on paying down debt, increasing dividends, and as a result, we have no greenfield projects coming through the pipeline. So we have a real shortage of new projects coming to add supply, and we can see demand looks generally pretty robust. So it looks like a tightening market, but I think the market still needs to see discipline.
I mean, this links into something that Mark was talking about earlier about this sort of, there was this fear of capital destructive M&A. But as you say, there are not that many greenfield projects coming online. And when companies are looking at resource replacement, there's going to have to be some M&A. When are we going to see investors turn and say, okay, you need to start spending some money and getting some new resources in the bank, so to speak?
Maybe, I'm coming from a slightly different background, and I'm working for Société Générale, which is actually a senior lender, so with a bit of a different perspective from the other gentlemen, less focused on value creation through the equity, on M&A, but more focused on the resilience of projects, the sheer quality of project and management teams, and the resilience of cash flows. What we see actually on the project side, and rebounding on your comment, is that after several years of really very harsh discipline, as mentioned by Mark, in the industry, strong deleveraging of everyone. This is the first. Last year was the first year when we start to see a rebound in the amount of debt raised by mining companies. It was also the first year when we start to see a bit of uplift in the explorations. And we start also to see some greenfields that often have been started before the crisis, that have been heavily reworked, phased out, capex reduced. A lot of the discipline we see on the corporate side, on margin, and on the balance sheet have been taken to the project as well. So they have taken time to arrive to fruition. So we've been working on projects such as Cobre Panama, Fruta del Norte, and so we do see a few greenfields. We also see that there is a bank market to support them with long-term competitively priced financing. What actually worries us is that for some of the juniors, the equity piece seems to be extremely difficult to find. And there is just so much a senior lender is going to lend to a project. So I think my question is really about how do you see the gap in the equity being filled from the equity investors, and should we just continue to see more involvement of the PE funds, which have been so far filling the gap with their kind of flexible financing solution, and with whom we have established a very good cooperation on the senior debt, since we are actually very complementary. They bring streaming, they bring royalty, they bring equity, they bring sub-debt, we bring the senior debt. But maybe more classic avenues of raising equity could be a preferable solution for some of the companies. So it's quite interesting to understand the dynamic here.
Yeah, I mean, so there's a couple of things that are clearly very different from 10 years ago when we had the last build cycle. So firstly, passive money has become a much bigger factor, which obviously focuses on larger cap, more liquid positions. So that's taking capital away from smaller cap equities, which is one of the reasons that we're seeing a bit of a shortage of equity funding. And also permitting environmental regulations, the barriers to actually building a new project are also much higher. So whilst it's discounted the value of some of the smaller cap equities, I think actually they should be trading at a higher level because they've actually started off down that permitting process, drilled out to a certain degree. And, you know, as we've seen with a lot of companies now allocating capital to smaller cap explorers, they've actually found they're much better users of capital than actually the larger major cap companies.
I mean, it is slightly odd that in terms of the clearly there are large pools of capital and potential capital in the large cap mining companies, but you know, they're not going to spend it anytime soon. I think that will come. It's a bit like the banks after a crisis. They only want to lend money to people that don't want to borrow it. So, so I think we're not. I think eventually they will. Yes, the grub staking some of the smaller companies. There is the PE money. You know, for us on the long-only side, what's been frustrating about this particular cycle and this upturn is that we're just not getting any inflows, and we would be typical of, you know, our colleagues over at BlackRock and Investec, that it was just really hard to get interest in the sector, to get interest in the funds and get inflows. And so what that means in terms of the money that we have available to invest in small cap companies is, you know, we will put a maximum 15% of the portfolio into exploration development, so cash-hungry companies, and try and support them through equity raises. But if another good idea comes along, and if we're not getting new money in, that means we've got to kick one out. If you know, we've got to one in, one out basis. So you know, we're limited as well. So there's a bit of a mix, but I think ultimately, as this cycle progresses, the large cap companies will end up doing some more, you know, some M&A and deploying some of those riches. Our generalist fund managers, of course, we always have different views with our own fund managers, because our European global equity fund manager in a meeting with Rio Tinto, and that's why we're not too happy about the prior proposed chairman. You know, they want equity to shrink. They want more dividends. They want more buybacks. Where we sort of want them to build new projects and preferably bid for some of the small caps we own in the portfolio.
I mean, I'll just add a quick comment to that. So as long as we keep seeing this capital discipline, whether that be dividends, buying back shares, or we see M&A, we aren't seeing any new projects being added, which just means that we're extending that positive market, that tighter supply, demand type metric. So I think it should extend a more positive outlook.
Absolutely.
Yeah, I think sorry,
I was just going to comment that we see actually companies developing a mix of organic projects with their own pipeline of projects that they will develop, on which they have the ability to accelerate or slow down depending on the market, depending on their objectives, financial objectives, and also trying to jump into the M&A market, let's say a bit more opportunistically, to accelerate their growth and create value. So I think if companies can stick to this discipline of continuing to develop their own assets, continuing exploring, continuing to build their own pipeline of projects, while at the same time having the savviness, as you say, I think to find the right opportunities on the M&A side, I think there we are going to see a very interesting corporate profiles in an environment where these companies have also deleveraged. So I think actually the next few years should be actually the years more focused on growth for these companies.
There's an interesting comment there from Neil about Rio Tinto saying, you know, they should be going out there and buying more stuff and building more projects. But, you know, Tom Albanese lost his job in the last cycle because he did too much on that side, and the investors got upset.
Yeah, look, I mean, the new chairman has said that he feels that the pendulum has swung too far the other way. So nothing is getting through the fences to the board. So they're, you know, they're sort of loosening that up, or it's becoming less tight, perhaps is the expression.
Absolutely.
And we're certainly seeing a pickup in strategic investment from our side. We're seeing, you know, an increasing interest in majors investing in junior exploration companies, and we're seeing very selected strategic investments, and there would be a lot more, but we still have a degree of reticence amongst, let's say, emerging producing companies from engaging until they've created the value. So it's not always just the larger companies saying, you know, holding fire. There's some great projects and some great emerging companies out there that are sort of holding on to try and retain control of the asset, which might be right, might be wrong, but in context of a dried up equity market, I think management teams that discover and push through a deposit to pre-development stage need to ask themselves realistic what their skill set is. Their skill set that discovery and value add process and then sell on to a major, or is it to try and hang on to the last minute through rounds and rounds of dilutive and high cost finance to try and get this into production and then only find that you get picked off in a distressed situation. So I think investors like us will reward management teams that have the courage to say, we've taken it as far as our skill set can go. Let's monetize what we can with a major and move on to the next project. So I think that's a real opportunity for the mid-tier, which is where the squeeze is. If you're an exploration company with a great project, you will get financing either from friends and family or from a major. If you're if you've got a world-class asset that has a decent internal rate of return and a low capital intensity, you will get offers of finance and you will get a takeover. It's that middle ground that are struggling to find the money.
I couldn't agree more with what you just said. I think that in the senior lenders world, we always think that a good project is always going to be developed and financed. This being said, I think one of the pitfalls is, I think we've seen in the last cycle, and I think you mentioned that, Neil, a lot of shortcuts being made on the due diligence, on not realistic assumption being taken on the length of getting the permits. Obviously, we are seeing today a bit more of resource nationalism in certain countries. So I think all this needs also to be taken into account. And the discipline that you have as management teams on the development of the project will reflect, I think will have an immediate impact on the ability to raise competitive sources of funding from either commercial bank like us or equity providers.
Fantastic. We have a question here.
Metals funds have seen redemptions. Why does JP Morgan generalists, why don't they buy gold stocks, which are much better run, which are historically pretty cheap? Same question for New City and Société Générale. So why don't these generalist funds only concentrate on Amazon and other cheaper stocks?
For our generalists, the gold sector is too small. It's not the benchmark driven, represents next to nothing in the benchmarks, and they just look back at 20 or 30 years of the history of the sector and say, well, actually, over the longer term, we're going to benefit by not owning gold equities anyway, which by and large has been.
But in 2011, they were loaded.
I can only speak for JP Morgan, and I joined them in 2010, and I sit within the global equity team. They didn't own any gold stocks. Now, some of the strategies that are sort of benchmark and just have like a 1% alpha target and will have 300 stocks in them, yes, they will invest in gold stocks, but it's more sort of quant driven. So yeah, they'll own Barrick and Newmont and things like that. I think for on the non-precious metal side, certainly our global and European PMs they do own and are overweight in the sort of Rio Tinto, Glencore, BHP because of all the reasons that have been mentioned, in terms of the balance sheet repair and the cash generation.
I mean, I think there's always a bit of sort of rotation bias as well, or at least of sector direction. I mean, they've done well to not own any gold stocks for an extended period. I mean, I agree to your point that we're certainly at a point where they're suggesting very strong value. I mean, gold stocks don't trade at 2 times NAV anymore. You can get a small cap at 0.5 NAV, so you don't even need a higher gold price. When I go in to speak to my investors, I say, look, we all have our own view around the gold price. I'm personally constructive, but we don't need a higher gold price for a lot of the stocks now. They actually stand up on their own. I still think it provides an important insurance hedge, but I completely echo Neil's view in that they're just too small, too illiquid, and the ones that are big enough generally have declining reserves, have an issue with having to replace reserves, and just don't really tick the boxes for those investors when they could own Amazon, which has clearly been a better pick than owning Barrick.
One of the trends we've seen just in that comment is, I know we don't have generalist funds, so we speak to our own book here, but is that we are seeing increasing interest from generalist investors in investing in the sector. Their real reticence comes from the value destruction that's been in the sector for a while, but they see that the sector is undervalued. And I think, come back to what others were saying, if we can get a few quarters of solid results and no crazy M&A and no low return projects being, built, I think, people might regain that confidence. It is a too small a sector for many investors, but there is a large enough pool of investors at different levels to come back into the sector if the sector can show some excitement.
I think where we are seeing some institutional interest is putting in inflation protection. So, we worked on a couple of pitches for, longer dated money, pension money that want to put in a combination of commodity futures and resource equities, just thinking about having an inflation protection component in the portfolio.
Excellent. Well, let's talk about your plans for the rest of 2018 and looking into 2019. What are your sort of investment theses going forward? Which commodities do you like? What sort of stage of development companies do you like? Which geographies do you like? Give us your thoughts on where you'd like to invest. Stephanie, do you want to start us off?
Yeah, maybe just our bank is clearly not focused only on gold. We are doing all type of commodity. Copper is certainly one we like, as well as zinc and all the base metal complex. We are also starting to be really excited about the lithium, cobalt, all nickel, all the EV battery mineral stories. Our institution has left behind the old world of coal, and sorry for the coal producers, but is clearly embracing vigorously the energy transition. So we are acutely aware of the uncertainties around this market, of the technological challenges of extracting lithium, of the difficulties of having a good read on the nickel market. But I think we are really willing to take a step into that sector and try to support the industry in that direction without abandoning the rest of the more traditional projects that we are traditionally supporting. I would like to kill a myth today, which is that there is no senior debt for good projects. Again, I want to repeat it because I hear that again and again, and I think there is a solid group of senior banks ready to support good projects rigorously run by a good management team and are ready to deploy long-term competitively priced capital that you can then use to support an uplift in the equity. So I think we are very excited about some of the market coming back into deficit, because this will push the industry to look at more growth in terms of new projects, as well as the new commodities picking up, which have also been, I think, supporting some of the growth in the equity market.
Fantastic.
Yeah, I mean, I'd echo that view that we're going into a bit more of a growth bias. My fund is closed-ended, so that gives me the luxury of being able to invest in companies that are a little bit less liquid. I can go with a bit of a longer time horizon, so I've very much got a value bias. Within that, I'm fairly heavily weighted towards base metals, and that's down to the fact that it's sort of longer cycle metal, there's a longer response time for new projects, so I believe there's a potential for supernormal returns for a more extended period. Gold holds an important weight, and that actually falls down more into the other camp, where that's more of a bottom-up valuation story, certainly in the smaller cap names. On the names that I'm speaking to, particularly sort of single asset companies, I'm pushing for sort of non-premium type mergers to try and get scale, and that comes back to that whole ETF passive money comment that I made earlier. I mean, we're seeing such a valuation differential between the larger cap and less liquid smaller cap names, and some non-premium mergers I think could be very constructive for the space. And the one complete contrarian outlier is uranium. Uranium's actually got a lot more interesting. So Kazakhstan cut production 10%, MacArthur River, Cameco have mothballed it, which is around 8% of global supply. So we've actually gone into deficit this year. We have a very clear outline of Chinese reactors being built. So we can see the demand and a complete lack of supply and a complete apathy again to building anything, because it would be uneconomic to build anything at this spot price.
Finally, uranium back.
Yeah. I was going to mention it this year. after mentioning it for 2 previous years. Well, in the recent period, a rich source of alpha for us has been President Trump. So we just wonder what next he's going to do that will help our portfolios. You'll have heard this before, but I got woken up at 4 o'clock in the morning on the election day by James, my colleague, saying it looks like Trump's going to get in. And I thought, oh my, I jumped out of bed. I thought, we totally positioned the wrong way. We're underweight gold. We're overweight base metals. Looked at the screens. Gold was rallying in the first hours, and I thought, we're going to get killed today on performance. By the time I'd gone into the office, it reversed, and we had one of our best months ever in terms of relative performance. At your conference and down in Cape Town in February, was on a panel and said that one of our conclusions from this EV revolution was that it would be positive for oil. So, you know, we had trimmed back our overweight in sort of base metals and the miners at the end of last year and put more into the oil and gas sector. Obviously, that sort of helped and may have run its course now. You know, we're along with the herd on, you know, overweight copper. Still think there's a lot of value there, but really we're all stock pickers. We want our alpha to mostly come from picking good companies. And I don't want to sort of blow up that alpha by being double weight gold or double weight copper or something like that. And you have a year where you've got good stock selection, but you've blown it up because you've made the wrong commodity price call, which, you know, we've all done and we will continue to do. So for us, it's still about focusing on those stocks, hoping to see some daylight of value, because there's a lot of cheap stuff out there, a lot of which should be cheap as well. But looking forward to eventually to a return of the lack of discipline and get a bit of an M&A rush, which usually helps us.
A bit more dumb money back into the market. Yep. Fantastic. And Mark, do you want to?
Yeah, I think a big theme for us and what we're looking for this year is value. I mean, the whole sector is undervalued, but some companies are cheap for a reason, and they, I think, dragging down others. So, but you know, solid management and good assets. And I think for us a key thing is to look at companies that are focused on, you know, still focus internally. You know, there's that temptation always to look at the next project to build or the next discovery. But what we find looking across all companies, not just in the gold sector, there's still huge amounts of debottlenecking, continuous improvement, and cost efficiencies that can be had. And particularly now with advances in robotic and, you know, other technologies for remote mining, you know, I think there's another phase here that can come through and really support the industry in fighting cost inflation, which is going to start coming through. So I think we want to see companies focus internal growth, internal debottlenecking, because there's so much value to be unlocked just by doing that before running out and building new projects. And if you do build new projects, you better have an IRR and a low capital intensity, because we're not going to be funding, you know, hundreds of millions of equity for a 8% IRR, you know, billion-dollar project. You know, that's just not going to happen. So, you know, I think that's where companies need to be. Every single company we see has huge room for internal improvement, both in terms of strategy and in terms of, you know, costs.
Fantastic. Unfortunately, we have run out of time, but thank you, our panelists, for an excellent panel. I only had to ask about 3 questions, so that shows what interesting people we had on the panel here today. So can I have a big round of applause for our panelists? Thank you.